Good morning, students. Hope you have seen all 4 videos that we made on last chapter, that is chapter 11, subdivision of journal. So today we will start our another chapter, chapter number 12 of our accountancy, that is GST, accounting for goods and service tax. So what do you mean by GST? GST is a comprehensive indirect tax levied or charged at the prescribed rate each time the supply sale is made of goods and services or both by a registered taxpayer. It means whenever there is a sale of goods or there may be resale of good, they will apply or charge GST on that. Means if we are purchasing a thing of 100 rupees for selling it to another one person for 120 rupees, so when we are purchasing, the seller will take GST from us, and when we are selling to someone, we will take GST from him. So it will charge on every resale of the same product. So GST is not charged on petroleum, alcohol for human consumption, import of goods and services, and taxes levied by the local bodies. Means GST will not charged on petroleum. Government allowed few products out of GST. They did not put these products in the GST slab rates. So these products are not liable for GST. First is petroleum, second is alcohol, and third is import of goods and service. Because for import of goods and service we have another duty, that is custom duty, that levied by government. So we do not allow GST on our import and export, because sometimes we need to be increase or decrease the custom duty. In case of GST we have only prescribed 4 rates, so we will not go out of these 4 rates. So GST we have only fixed 4 or 5 rates for GST. But because in case of import sometimes we need to impose up to 100% of the value of the goods. So we have removed the import goods also from the GST, because it will help government to secure our local production companies to make more and more people available local products within the country, to keen from using the imported goods rather than to use manufacturing goods that manufactured in India. As of result of GST, almost all indirect tax are merged into one indirect tax, that is GST, except the tax on above mentioned goods. As we know, all the taxes that we have, indirect taxes, are in earlier, like value added tax, service tax. All these taxes they have implemented into the GST, other than those taxes which are still payable by the petroleum, by the alcoholic, and we need to impose the duties on import of the goods. So all the taxes that we levied on these 3 products are out of our GST. Other taxes we merged into the GST. So what is the motive of the GST? That is, first is to develop common national market by having one indirect tax. Earlier every state government have his own slab rate for their taxes. Like in Delhi, in Delhi VAT tax is different that we charging in Uttar Pradesh or in UK. So there is a difference between the tax slab rate on each of the state. And because India is a diverse country, we purchase from other state also. So in case of purchasing of other state, there may be a number of difficulties we found because of the different taxation system between the each state. So they brought one nation one GST, one nation one taxation theory, on which ways they introduce GST. Next thing is decrease in cost of goods by removing cascading effect. Cascading effect is the double taxation. When we are purchasing something and they levied on sale tax on it, then the another one will leave the tax on the value added by sale tax also. Like I purchased 100 rupees goods and I paid 20 rupees sale tax. So I received the goods of 120 rupees. When I will charge from the customer, I will charge on that 20 rupees also that I paid to the seller, whom sell goods to me. So there is a cascading effect, that is taxation on taxation. Tax on taxation means जो 20 रुपए हमने टैक्स के पे किए थे, हम उस पे भी टैक्स पे कर रहे हैं या चार्ज कर रहे हैं दोबारा से. सो दिस cascading effect is completely removed by the GST. Next point is easy of doing business. GST is a comprehensive indirect tax, means that almost all the indirect tax and duties are merged into it. Earlier we have to fill a lots of duties and a lots of taxes for selling our goods or purchasing of goods. So the businessman found it difficult to keep his business activities with all these formalities. So removing all these taxes and merge them into the GST, it make easier for the businessman to form his liability or to complete his liabilities against the taxation. Because in earlier system he have a lots of duties that to fill different type of duties, like when he purchasing from other state, there is a central sale tax, state sale tax, value added tax. So he need to fill up many duties before purchasing or sales. So after implementation of GST in the business, he do not need much specification, he just need a GST number by registering in GST. Next thing is simplify complication of indirect tax. As I told, it removed a large number of indirect taxes, so it is now simplify all the taxes under GST. A business has to comply with GST along as against many taxes under the earlier indirect tax system. Better and effective tax management. As we know, it's better to pay a single tax rather than to pay 12 or 13 tax and to fill different type forms and complete the formalities of different type. It's easy to cover it in within a single tax. So it help to reduce the burden of management of different taxes also. Next thing is attracting FDI, that is GST will attract foreign direct investment. As a major barrier of more than one taxes are attracting FDI is removed. When we in earlier system, for attracting FDI, we have a lots of number of barrier. First barrier is a lots of taxation, then a number of formalities we have to done before starting a business. So other companies keen to open or set up a business unit in the India, but after the GST implementation they do not have to complete much number of formalities and paperwork. They same as Indian authors, they need to be implement only GST. So government implement GST for making FDI easier for others. Other thing is uplifting GST. India was a cash economy, and as a result, the data of computing gross domestic product was not reliable. As we know, 90% or 80% of our economy depend on cash basis. We do not use much of electronic transfers or check-based transaction. We still trying to be on cash basis. That is a drawback for our economy. That's why our economists have found a difficulty to compute our gross domestic product also. With the introduction of GST, business was channelized, resulting in more authentic data of GDP. Also, as a result, GDP will be higher. As the GST would channelized in our system, it would be easier for the economics to also to get to know what is the condition of GDP of our country, because then the cash will channelized through the channel. Now everyone need to be a bill that is by GST, that need a GST number also. So it will count जो पैसा हमारा चैनलाइज में है, मतलब अभी मार्केट में है, but in not counting according to the government, that will come in knowledge of government by implementation of GST. Eradicating cash economy. As we know, we have a 80 to 90% based on the cash economy, so we need to be put more on electronic based transfers, like we ATM cards and Paytm and other means we will use to payment and to receive cash from other person, because in case of cash it is not countable that who is paying whom how much money. But if we are using it through the channelized channel like banking system, like online payment system, so this will make the money in the channelized of the government. Okay, after implementation of GST, objectives of GST and meaning of GST, our next point is registration under GST. Whom need to be registered under GST and whom not need to be registered under the GST. So registration under GST is compulsory. We have two conditions: if the business is in non-hill area and if the business is in hill area. So for non-hill area, gross turnover from supply sale of goods within the state, intra-state in a year 40 lakh or more. If the person or business having turnover more than 40 lakh in a year within the state, means within the state, intra-state is also known as within the state. If within the state they had turnover more than 40 lakh, then the person need to be registered under GST. That is compulsory. It is optional if your turnover is less than 40 lakh. It is optional for you that you may be registered under GST or may not be registered under GST. So it is up to on businessman that he want to be registered or not registered under 40 lakh. But over 40 lakh, if he have turnover within a year, then he need to be compulsory registration under GST. Okay, then gross turnover from supply sale of services within the state. First thing, if we are selling goods, we need the turnover need to be 40 lakh to be registered under GST. And compulsory GST registration is after 40 lakh. But in case of sale of services, we need to be registered under GST if our gross total of year is 20 lakh. Means a sale of goods value is more than 20 lakh. So there is a difference between sale of goods and sale of services. In case of sale of goods, GST compulsory after 40 lakh, but in case of services, GST is compulsory after only 20 lakh. So there, if the business is in hill area, then we have another process of registration under GST. That is, if the gross turnover of supply of goods within the state is in a year is more than 20 lakh. For hill area, the amount that after the amount that we need compulsory registration of GST, that is 20 lakh. So if our business turnover of last year reached more than 20 lakh in a hill area, then we need to be compulsory registered under the GST. But in case of sale of services, if our gross turnover of our last year reached more than the 10 lakh, then cross more than the 10 lakh, then we need compulsory registration under GST. So there is a difference between hill area and non-hill area. And other thing is sale of service and sales of goods also. The business has interstate turnover, means transaction between the two states. It should noted that no limit is prescribed for interstate turnover. Thus, registration is compulsory if there is a interstate turnover of even a single rupee. If you are trading out of your state, then you have to be registered under GST. That is compulsory. Even you are trading of 1 rupees or even you are trading of 5 rupees. So trade within the state, you have some prescribed limit for registration of GST. But if you are trading out of your state, then whether it is service or whether it is trading in goods, you need to be compulsory registration under the GST. Goods and services are grouped in the 5 categories. The GST is applied on the goods and services as specified on the category. The rate prescribed first is 0%, second is 5, 12, 18 and 28. 0% is for those household goods that we use in daily use. So maybe these are the necessities goods, those without these goods we can't live. So we put them in the 0%, like milk, food, vegetables. On these items we not charge any GST. And 28% is for luxurious goods that we use in our life. Luxurious goods like high class cars, high class watches, high class everything that have a high value, that will come under the luxurious goods. So we have categorized GST into three categories. First is central goods and service tax. Second is state goods and service tax, and third is integrated goods and service tax. So central and state goods service tax lived on every transaction. If it is happened within the state, then it will leave central and state government tax on half and half basis. If the taxation rate is 12%, then 6% of the tax will go government, central government, and 6% of the tax will go in the state government hand. But if there is a integrated goods and service tax, means if the transaction happened in between the states, means out of the state, then the tax will go in the hand of the central government, that is IGST, integrated goods and service tax, that will lived by a full amount, but central and sale tax will divided between two, that is state and government tax. After this we have next point, that is input GST and output GST. GST is levied or charged and collected by the seller of the goods or services, or both for and on the behalf of the government. It is termed as output GST. And the purchaser of the goods and services, or both, pay GST on the purchase of goods, is termed as input GST. Means if I am purchasing a goods from a seller, that I will pay GST to him, that is input GST for me, but the seller that is collecting GST from me, that is output GST for him. So if he, because the seller is also paid GST to someone, so he have an input credit for his GST. Like he purchased 1000 rupees good and he paid 10 rupees GST on that. So now he have 10 rupee input credited because he paid to someone. Now when he charged from GST from us, that is output GST. Like he charged 20 rupee GST from us when he is selling to goods, then he will get output GST that he need to pay to the government. So out of it, like he received 20 rupee GST from us and he have 10 rupee input credit from when he purchased good, he paid to the seller. So he have 10 rupee input credited and 20 rupee output credit. So he will set up the amount that he paid to the seller, and with the amount that he charged from the purchaser. 20 rupee he charged from us and 10 rupee he paid to that seller who sold goods to him. So what he will do, he will set up the amount that he have credit balance, that is 10 rupee, and the remaining 10 rupees out of 20 he set up his 10 rupees, then remaining 10 rupee he will pay to the government. If the case is reversed, that he have 20 rupee input credited that he paid already and he charged only 10 rupee output from us, then after charging the output from input, he still remain kept 10 rupees input with him. He can't say that government will pay back to him GST that he paid more. He will set up after in his next transaction, he can't ask back GST from government. GST paid input GST is set off against GST collected output GST. As I told, in the prescribed manner, the method of setup of input GST against output GST is discussed later in the chapter. Balance amount after setup is either receivable, that is balance of input GST, and or payable, balance of output GST after setup. The GST paid input GST is not a cost for the purchaser, and GST collected is not income of the seller. As I told, GST collected by the seller is not an income for him. He have to pay it back to the government. So what he paid, he will set up that amount from collected GST, and the remaining amount he will pay to the government. GST is a value added taxes. Input GST can be set off against the output GST. As I told, the balance of input GST that the seller have, he can set off against the output GST that he charged from us as the prescribed manner. Input GST can be set off against output GST, and GST is a value added tax. As a result of setting off, GST is levied on the value added.
Okay, so the example is if the seller purchased 1,000 rupees goods and paid a GST of 10 rupees on that, so the cost he beared that is 110. After that, he added 10 rupees profit in hit in those goods value, that is 100 rupee plus 10 rupee, that is 110. Then he charged 10% GST from us also, that is 11 rupee, because he charged 11 rupee, that is output, and he already paid 10 rupees, that is output, that is input. So he will pay only 1 rupees to the government, because he will set up that 10 rupees with this 11 rupee that he charged from us. The 1 rupee that he is paying, that is on his value added, because he added 10 rupees profit on the value that he purchased good. He purchased 100 rupees good and sold us to in 110. So the 10 rupees that he added as a profit, the GST that on profit he will pay to the government, that is 1 rupee. So it is a value added tax, same as value added tax. So he need to pay only the value that he added, that is 10 rupee.